Welcome to the accounting class. In this session we're going to take a first look at banking for accounting. So wagons roll and let's away. The days when business owners walked around with rolls of dollar bills are long gone. Businesses make use of banking so that monies are kept securely and transactions processed easily across states and indeed across countries. Businesses have bank accounts. There are different types of accounts, and a business will choose the accounts that serve its purpose best. The most common type of account is called a checking account. Most of us have a checking account we use for day-to-day transactions in our personal lives. We may also have a savings account, an account that will pay some interest on the money we have deposited with the bank. Many of you will also have a credit card account. These are also useful in business. Money market accounts are popular because they pay slightly higher rates of interest than savings accounts. They usually require that you leave your money in the account for a certain period of time to get the maximum benefit on interest. Most transactions are processed through the checking account, and this is the account that we are going to focus on first. About 30 years ago, most of the payments were made from the checking account using physical checks, which is where the name of the account comes from, of course. Checks are still important, but payments are often made in other ways. Debit cards are used by businesses as well as by individuals. EFT, electronic funds transfer, is used more and more because it provides a way of fast-track payment. Withdrawing cash is still used to provide a small fund for small payments. That fund is known as petty cash. A business account is set up for the business. Sole proprietors and partnerships should not use the account for personal transactions, other than making cash withdrawals from the business. When an account is first opened, an agreement is signed with the bank to accept the terms of service. All the transactions with the bank will be either inflows of money, where deposit slips are completed, or outflows, where check stubs or other information are kept. Consider what happens when you write a check. There are three parties to the transaction. You are the drawer. You wrote the check. That means that you have instructed the bank to pay the check. The bank is the drawee. The bank transfers the money from your account. The person to whom the check is made out is called the payee. The payee receives the cash from the bank. This may be as cash or by transferring the money to the payee's account. The check that you write is given or sent to the payee, whilst the stub or a carbon or a duplicate copy is kept safe for record keeping. On the check, there are three important pieces of information. The date should be the day on which the check is written. The name of the payee is the person or business that will receive the money. The amount of money is written both in words and figures. When the check has been prepared, it will usually be signed by a second person in a business. This second person has the function of authorizing the transaction. Having two people required to complete the process is referred to as the segregation of duties and is important in helping to prevent fraud. It is up to the signatory to check that the date is correct and that the payee and the amount can be matched to other documentation that should accompany the check. Where a debit card is used for cash purposes, receipts need to be kept. A debit card requires the use of a PIN, a personal identification number, which should be known only to the user. There should be strict controls on the issue of a debit card, controls which limit the maximum amount that it can be used for. EFT, electronic funds transfer, is becoming a common method for making payments. Authorization can be given over secure internet connections. Regular payments can be set up and made, but records of transactions are still required. That record of the transaction should also include a record of authorization for the payment. Similarly, whenever deposits are made, there should be a record kept. Checks can be endorsed. This frequently happens with businesses. The most common endorsement in business is for deposit only, right? For deposit only, which means that the cheque must be paid directly into an account. It cannot be taken to the bank and exchanged for cash. A blank endorsement is when you, as the payee, sign the cheque on the back, allowing any bearer to go to the bank and cash the cheque. In addition to the deposits a business makes and the cheques or other payments authorised, there will be other transactions with the bank. On a bank statement, there will be additional deductions from the business account, which will be charges for cheques used, possibly a standard charge for each period for providing the banking service, and a charge for an overdraft facility if that has been used. But there can also be additions to the business cash, where interest is added to the account. Checking accounts will only attract low interest, if any, whilst higher rates are paid on saving accounts and of course higher still on money market accounts. Interest received will represent income, whilst any charges are an expense of running the business. Credit card accounts may be used by some employees. Often a business will use such an account where there are a lot of expenses associated with travel. Receipts for any payments must still be kept. A credit card account will attract a high interest charge if payment is not made regularly. Limits should be applied to credit cards, and they should not be viewed as a loan. This ends your first session on banking. Thank you for watching and for listening.